Mastering currency risk from exposure to execution. So, in today's global economy, managing foreign exchange, also known as FX, risk is more critical than ever. This session explores how organizations can identify and assess their FX exposures, implement effective risk management strategies, and optimize the final stage of the process. Learn how to reduce costs, minimize bank fees, and improve operational efficiency through smarter FX execution. Now, whether you're a finance leader or operations professional, this session will provide actionable insights to help you take control of your FX risk from start to finish. And this session is brought to you by Convera. Now, speaking of Convera, Karim Francis brings nearly 2 decades of expertise in capital markets. In 2023, he was appointed as the head of the Foreign Exchange Risk Management Department for North America at Convera. Throughout his career, Karim has successfully supported hundreds of North American companies in crafting customized foreign exchange risk management strategies. And that is a fraction of what this guy does. Karim, how are you today?
I'm great. Thank you, Rob. How are you?
I'm fantastic. Where are you coming to us from? It looks like your background shows the CN Tower, so I'm assuming we're in the same city.
We are for now because as you know, I cover North America. So today I'm in Toronto. I might be tomorrow in Quebec or in the US.
Wonderful. Well, I hope you're enjoying this weather. Stay cool. And I'm going to give you the last block of our session today. So it's over to you for the next 40 minutes, and I'll keep an eye on our chat box, and you can do so as well. And if anybody chimes in, feel free to answer that question. Of course, please reach out to him as he's putting on his presentation. Over to you.
Thanks again, Rob. Thanks for the introduction. And I'm just going to start by thanking everyone who took the time to join that work session on currency risk management today. And for the people that are staying a bit late to join that session, again, thank you. Maybe before we start, and maybe we'll give it an extra minute for people to join, if you can just launch the poll and answer the question about risk management. Currently, in your company, are you exposed to any type of risk, especially currency risk? And if yes, is there any type of hedging solution that you are implementing? So if you can answer that, and then we can start the presentation. Perfect. Okay, so half of the attendees, as you can see, have currency risk from the organization they work for. So that's great. It gives you an idea of the attendees. Let's dive into the presentation. No need for introduction. I think you know me by now, thanks to Rob and the introduction. But let's talk about today's session. Throughout the session, we will be exploring several key aspects of managing financial risk, definitely focusing on foreign exchange exposure. By the end of the module, I would expect you to be able to identify and categorize the different type of foreign currency risk. The second aspect would be understanding the full risk management cycle, or the wheel of risk management, and how to build a strategy. And the last point is recognize and hopefully avoid common pitfalls when you deal with foreign currency risk. So first, to be able to understand currency risk, we need to define what is currency risk, or in our term, we call it hedging. So when a company operates across borders, then definitely, with no doubts, they will encounter several risks. Some of them are controllable, and some of them are not. If I take some example of uncontrollable risks, we can talk about geopolitical events. War between Russia and Ukraine, instability in the Middle East, elections, especially the one that we've seen back in November. All of these aspects are uncontrollable risk for companies. They have zero impact on the outcome. Second example, decision made by central banks to fight inflation, monetary policies. There is no impact from the company on the outcome. The same as macroeconomic shocks, 2008 subprime crisis, tech bubble. All of these are uncontrollable risk on the currency. Now, on the other aspect of things, controllable risk are mostly internal for the company. For example, disciplined budgeting and forecasting practices. How the company strategically contracts their sales or even structure their debt, and financial risks. Fortunately, FX risk, along with interest rate risk and commodity risk, falls under the umbrella of financial risks. And these are definitely controllable risk, which means the company can take actions to manage and mitigate that risk. So first, let's define a currency risk. It's also known as exchange rate risk or foreign exchange risk. And it's definitely the potential of a financial loss resulting from a change or a variation in the exchange rate. The risk will impact the business potentially on several aspects. It might be the assets, the liabilities, or the cash flow. So this is in a nutshell defining the risk. Now, where does this risk come from? The type of currency risk can come from three different types. The first one is what we call the transactional risk. Transactional risk is the risk from an exchange rate changing between the date of initiation of a transaction and the date of the settlement of the same transaction in a different currency. Because of that timing difference between the date we initiated and the date we received the fund or paid the fund, the fluctuation of the currency might impact the business, and this is a currency risk that comes from that side. The second type of risk is the translational risk. It's also called accounting risk. It only touches companies that have subsidiaries that operate under different currencies. Once they consolidate all these financials under one set of financials in the functional currency of the parent company, this creates a translational risk. The last type, which is the most complex type, is the economical risk. It's the risk from the exchange rate fluctuating, impacting a future ability for a company to be competitive in the global markets. So let's look into each one of these risks with an example so we have more clarity on where these risks come from. As I said, a transaction risk, it depends on the operation of the company, so it's imminent, you can see it right away. It can come from three different ways. The first one is the account receivables. For a company, your sales made in a foreign currency can lose value if the exchange rate shifts before payment is received. And this is the timing difference between, as we said, initiation of the transaction and the receipt of funds. The second type is the account payables. It's exactly the same concept, but on the payable side, you have to pay a vendor in a different currencies at a different or later stage in time. And these come, or the risk comes if there is a fluctuations, which makes you pay more a local currency than you needed to pay because there is a currency move. The third aspect is capital expenditure. A company trying to renew the machines, a library or a university trying to buy a telescope from a different, built in a different country. This also, it's a longer term project. It might impact the company with the fluctuation of currency. To understand that, I took a Canadian company that's listed in the stock exchange, CAE Inc. They manufacture simulators in the aviation industry, and most of their clients are US-based clients. So Canadian manufacturing, all their payables are in Canadian dollar, receivables are in US dollars. Because that cycle also is not a very short cycle, if the US dollar depreciate in the future and the receivables became less in Canadian dollar, this might impact them. A transactional risk directly affects the cash flow, as you can see. And to be able to mitigate that risk, you need to timely hedge with a strategy these future receivables in that example, or payables or capital expenditure. This specific company, we always look at natural hedge first. Natural hedge meaning if you have any receivable in US dollars, do I have any payable in the same currency? I can match them together. Even if the timing is not at the same period, we can always use instrument to match these two currencies. So this company uses natural hedge when possible, and definitely financial instruments that we will talk about to mitigate the risk. Now we go to the second set of risk, which is the translation risk. As you know, it's accounting risk, so it's periodic, depending on when the company is consolidating the financials. This impact, or the translation risk, is an accounting impact. There is no real impact in terms of dollar value. But as you can know, when the earnings or the liabilities or the assets are moved from one financial set to the other ones, this might impact the financial ratio on the consolidated financials. Most of the companies do not hedge that exposure, but if you have some covenants and these reporting or consolidation might impact those covenants, then potentially you have to look at hedging these translation risk. Example, Shopify, e-commerce platform, again in Canada. They have a subsidiary in the US that is listed on the NASDAQ. When they consolidate the financials, depending on how the US revenue or the US currency exchange is doing at that time, this might be a good sign for the company consolidated financial or a bad earning reports for the financial consolidated financials. The company, as I said, decided not to hedge because most companies do not hedge that type of risk, but they spend way more time on the earning calls and in the notes explaining the impact or the real growth of the business by removing the FX component from it. Now we move to the third one, which is the most complex one. It's called the operational risk, economical risk. This is mostly, it occurs when there is a long-term cycle for a product, and we'll talk about it. The impact on the exchange rate can impact the market share of the company, the pricing, and the investment decisions. If I look at Bombardier, they manufacture aircraft in Canada, sell them to the US. The cycle of building a plane is way, way longer than a regular cycle. So if you're ordering a plane today, you receive it in 10 years. Potentially, the currency at that time might make your company less competitive to compete against the local competitors. In that example, against Textron and Gulfstream. The solution to be able to hedge these type of risk, and we're talking like 10 years, 7 years in advance. Usually, companies can hedge, at least with Convera, a company can hedge up to 5 years in advance. When you have contracts that you deliver 10, 15 years in advance, sometimes it becomes more complex to predict if you're going to be competitive at that time or not. The way to mitigate that risk is definitely with financial instruments, natural hedge, but also it's more strategic decisions from the company to look at global sourcing, to look at pricing, to look at production locations, so maybe move manufacturing into the local market, and definitely market diversification, not to be impacted by one specific currency and market. So now that we talked about the type of risks, where do they arise from? Now let's talk about what impact the market. Why does the FX change? And these, in a very simple way, these are 3 pillars that usually move the market the most. The first thing is the central banks. Since after COVID, we start increasing, or the central bank start increasing interest rates, we've seen a movement in the currency. In a very basic summary, when the central bank increases interest rate, that currency becomes more attractive for investors and for companies to hold that currency at a higher yield. The currency strengthens. So this impact moves the currency. On the other side, a drop or a cut in interest rate depreciates the currency. The second set of indicators, which are the economic indicators, we all monitor the GDP, the sales, the CPI, so inflation, employment. All of these generate a reflection of the health of the economy. They can be leading, they can be lagging indicators. But these indicators give the sentiments of the market of where the health of the economy is going to be in a couple of months, in a year. And definitely the health of a certain economy or specific economy has a direct impact on their currency. And the last I would say the last area is the global events, as we spoke about, is geopolitical uncertainties, wars, elections, disaster in a certain region. All of these have a direct impact on the currency. Now we understood that the currency or the risk comes from a fluctuation of the currency. We understood where does the risk come as a company, from my account receivables, from my financial set, or on an economical basis. Now, what impacts me as a company? So first of all, I'm going to start by saying currency risk impact all type of companies, not only the small and medium enterprise. Even the multinationals that have the means to mitigate the risk are impacted by the currency risk. I'll give you two quick examples. The first one is Apple. In Q1 2024, if you look at their earnings, they dropped by 2.5%. And this is under translational risk. Most of Apple's revenue are generated by outside of the US. So when they consolidated these revenue or these earnings on the set of financials, then they had the loss of earnings by 2%, or they didn't get to their numbers by 2.5%. Another example, Volkswagen generated a $1.9 billion loss in 2024 euros in 2024 because they didn't implement a hedging strategy on their currency risk. So every single company that operates cross borders, if they have two sets of currencies, they are impacted by the currency risk. Now, from your perspective in the company, what impacts you? If the currency changed 10% over 3 years, you don't really have an impact because you will have time to adjust. You will have time to adapt to that change. You can reprice, you can change your pricing on your customers, or even you can negotiate with your vendors. What impacts you is an unexpected sudden move of the currency that you're not prepared for. And this is where I put these two, Trump 1.0, Trump 2.0, because these are the recent ones. Even the COVID era, we've seen the same thing. Under the first mandate of the President Trump, we've seen a spike of the US dollar. And after that spike, back in April, we've seen a drop of the currency by 15% or 14%, less than 6 months after that. So in 6 months period, we've seen a drop of the currency on the USD CAD by 14%. You can imagine that some companies do not make 14% in profit margin. So if you're in that scenario and you don't have any risk mitigation solution, then you lost your profit margin. And potentially, if you're just started in the market, you might be out of business. Exactly the same scenario happened in the second mandate, where the currency in USD CAD, I'm talking, spiked to the 148, and then we dropped to the 135 level in 6 months period. So again, a drop of 13, 14 cents in a 6 months period. This is what impacts you, especially if your profit margin is low, and we'll talk about that later on. Now that we understand where the currency from, how do we mitigate that? And this is what we talked about, the risk management cycle. It's very important to follow that cycle to create a strategy. First of all, the planning, understand, and we'll discuss each phase separately, but the planning is building the strategy. Execution is how am I going to execute the strategy, and evaluation. Your business is in a constant evolution. The market is in constant evolution. Your supplier changed. You lost a big client in a certain currency. You need to reevaluate the strategy for the following year. If it makes sense to stay the same, or you need to change it to be able to adapt to your new circumstances during that year. If we dive into the first section, which is the planning, to be able to determine a strategy, you need 3 pillars. And this is a very basic way of looking at the strategy. The first layer is, what's my percentage of hedging? And when I say hedging, it means locking the rate for a future date. So I'm removing the fluctuation of the currency impact on my business. So what's my percentage of my net exposure I need to cover? I need to lock the rate on. The second aspect is how far in advance I want to hedge. So my tenor, as I said, we can hedge at Convera for 5 years in advance. Most of the companies hedge up to 2 years in advance, but if you have a contract with the government for 5 years, you might need to lock the rate for 5 years. And the last type or the last pillar of the strategy is the product. Maybe you're familiar with the forward contract. We have 130 different products that mitigate the currency risk. The more risk you want to take, the better rate you can get in the future. We'll touch on that section too. Percentage of coverage. How do we calculate that? How do I decide if I'm hedging all my net exposure? First, I need to understand what is my net exposure. And I said that at the beginning. My net exposure means how much foreign currency am I receiving? How much foreign currency am I paying within my financial year or my period, let's call it? I net these two, even if they don't fall under the same timing. And this is my net exposure. And which currencies? It might be more than one currency. The second question is, if my company is exposed to 50 million, let's call it US dollars of foreign currency, do I have to hedge? The question should be reversed. What percentage the 50 million represent from my revenue or from my cost of goods sold? And in other terms, if the 50 million represent 90% of my sales or my cost of goods sold, definitely there is an urgency to hedge. If they represent 5% of my total sales, then you have less urgency to hedge, because if an impact on the 50 million is minimal on the overall impact of the EBITDA. The same thing applies for the margins. If I have a very healthy margin, if I'm a technology company that already invested or have a product that's up and running and I'm capitalizing on the product and I have 50-60% profit margin, then I have less urgency to hedge, because a 10% move, I'm still making money, versus a tight margin like a commodity trader that generates 5 to 10% in profit margin, have way higher urgency and is more sensitive to the fluctuation of the currency than a higher margin business. Do I work with a budget trade? Do I work on project? Do I have seasonality in my business? Can I pass the FX exposure to my customers? If the market moves, can I adjust my pricing? So all of these will determine what is the percentage that you need to hedge. In summary, the more certainty you have, the more the percentage of your exposure from your revenue or cost of goods sold, the lower margin I have, the higher percentage I need to hedge. Now I move to the second point, which is the tenor. How far in advance I need to hedge? Again, are you hedging a known exposure? Are you hedging a forecasted exposure? How good the forecast is and how sure the forecast is? Are you working with a project? Is Netflix giving you an animation project in Canada for 2 years and you need to hedge it, so you have a certainty they're going to pay you on time? Or it's mostly on the forecast side, so you have to go lower in time and in percentage potentially. Do you have enough liquidity to pay for a margin call? I'm not going to dive into the credit side of the hedging here, but it's important to know the longer you go in time, a fluctuation of the spot today or the currency today will impact you on the mark to market of your position. I'm not going to go into the detail, but this is a question that you have to keep in mind to see if you have to go on a long term or a short term. Now we go to the products. What product did you use in the past? I said we have 130 products. Forwards are the most common ones. Are you comfortable with losing a protection to get a better rate? Are you comfortable to use leverage? A lot of questions about the products, especially if I move to the second layering of the products. First of all, spot is not a hedging product. Your strategy might be to be 100% on spot, as long as you can justify it, understand the impact of having spot on your EBITDA and how much in dollar value it might cost you, then you're fine. But it's not a hedging product. It will give you 100% flexibility because you have the luxury of deciding when you want to convert, but it gives you 0% certainty because you're not locking a rate at a future date. The forward contract, for those who are not familiar with the forward contract, it's an agreement between two counterparty, your company and the bank or the broker, so the counterparty, to deliver a specific notional amount at a future date at a set rate upfront. So in the very simple term, it's a spot that you deliver in the future. Now, it doesn't have the same rate as the spot, but it's a spot that you deliver in the future. It gives you zero flexibility because upfront, you know how much you're going to be paying or receiving in 6 months, but it gives you 100% certainty because even if there is a fluctuation of the market, this will not impact your agreement with the counterparty. The last type of product is the structured options. We call them zero cost options, so there is no upfront cost on these ones. The idea of the options, most of them are derived from the forward. It will give you a forward rate that's worse than a forward or better than a forward with the disadvantage or advantage that comes with it. It will allow you to participate. Some products can allow you to get 300-400 points better than the spot with the risk that are assigned into that. I can spend 2 hours talking about products, so I'm just going to leave it to that. But just understand that there is 130 different products, and it will be adapted to your need and to the market conditions. Once we determine the strategy, what's my percentage of hedging? How far in advance am I hedging? What type of products am I using? It's very important to put that on paper, and we call it a policy. So putting a hedging strategy on paper, it's called a policy. And why it's important? First of all, it determines the guidelines of your hedging. It determines, from a company perspective, how do I have to mitigate that risk? The second is it creates continuity. We've seen a lot, or I've seen a lot in the past, where the decision maker leaves, but there is no one who understands how to operate the hedging, so they just leave it floating, and this might impact the business. So the third point is it removes responsibility from one person. Usually, the controller, the CFO, the VP of finance are not just focused on foreign currency. They have 15, 20 different projects that they're working at the same time. New ERP system, financing, restructuring of debt. FX would fall under as one of the last priorities. They don't want to take responsibilities of making what they think is a bad decision or a good decision. So having that on a policy approved by if it's a public company, by the board, by the ownership, is very important, because this means that the decision or the responsibility doesn't fall under one person decision, but it falls under everyone is okay with the same strategy. And on the other side, it creates control from the board, because if you have to deviate from the strategy, then you have to get approval from 2 senior executives. So this was the first step of the wheel. The second step is execution. We created the strategy. How do we execute? First is what we call a static strategy or static hedge. Static hedge means I have a project for 6 months. I come today, I decide to hedge 50%. In one shot, I just lock my 6%. So I lock the rate on a monthly basis for 50% of my need, and I don't have to worry about the currency. It's done, it's behind me. That is called a static hedge. The second type of execution can be a layered hedge, mostly used by companies who have consistent need, forecastable over a certain period of time. What they do is, in that specific example, they have 75% hedge for month 1 and 2, then 50% for month 3 and 4, and 25% for month 5 and 6. And every single month, they add a 25% layer to keep the strategy looking as a ladder. As I said, high forecastability on the short term, forecastability on the long term. The good thing about this strategy, if you have consistency of need on a monthly basis, it will average up and average down depending on how the market's doing. Because as you can imagine, for months 5, to get to the 75%, you created that 75 in 3 different hedges, which means 3 different rates. So you will never be very far from the market. Third type, again, these are just a couple of examples. Third type is a rolling hedge. A rolling hedge is a combination of a static hedge and a layering hedge. So you start with a 6 months hedged at 50%, and every single month you add month 7. So month 2, you add month 7, month 3, month 8, and you keep every single point in time. You have 6 months in advance hedged at the ratio that you decided to hedge. And the last example for today is the swap. Swap is used for 2 different aspects. The first one, I mentioned at the beginning, if you have euros that you're receiving today, but you need to pay in 6 months, to match these 2, so there is a time mismatch. To be able to match the time, you use a product called a swap to move one liability to the future or one receivables to the future. Now, on top of that, so how do we execute? We decided we're going to execute, let's say, with a static hedge. Now, when do we execute? Is today a good rate? Is tomorrow a good rate? Is in 6 months a good rate? The beauty of the limit orders mean I'm going to try to target a certain rate that is not achievable today. Every single company work with their own technical analysis. So we do our own technical analysis, and we work with the companies to try to match the either the high of the range or the low of the range by using the orders. The orders are not only done for spot, they can be done for any type of hedging products. So we can do exactly the same thing, but with hedging, saying I want a target to reach today on the euro side if your seller is 117, 118, if you're a buyer, 114, 115. And this will be based on a certain technical analysis that we operate on our end. At the end, we come back, as we said, it's evaluation. How did we do as a business? And at the beginning, we have to start with a benchmark. What are we trying to achieve at the end of the period? Are we beating a budget rate? Are we beating the average spot? What are we comparing our strategy to? We come back, our business might change, our supplier might change. One of the suppliers might accept local currency today, so I don't have any exposure on that side. Maybe I lost a customer that I used to receive a foreign currency from. I need to reevaluate my strategy. Either I decide to continue with the same one if nothing changed and it makes sense, or I need to switch my strategy and change it. So the strategy is in constant evolving depending on your market, because your company is evolving and the markets are evolving. Now that we discussed the strategy, I'm going to share with you the common pitfalls that I've seen during my past 22 years in capital markets on the currency side. I'm not going to talk about all of them. Maybe I'll focus on a couple of them. But one of the biggest, I'm not going to call it mistake, but pitfall, a lot of small and medium enterprises, they underestimate the currency risk. And most of the time, they think they can beat the market. Especially, and this mistake happens a lot when the market is in a range. And I'll give you an example. In 2024, from January till October, the market moved in 400 points around the 136 level. This gives comfort to the company because if they didn't catch the rate they want today, they can wait a bit and catch it at a later stage. The problem is if they don't convert today because they're trying to time the market or beat the market in their terms, the market might move or run away from them, and this is where it becomes more impactful. A lot of companies came asking for help when it was too late to be able to help. The second type of pitfall is the inconsistent hedging practice. They start with a strategy, then for two reasons, either the person, the decision maker, becomes very busy with other projects and this falls under the radar, or on a different note, emotion comes back and say, you know what, I think the US dollar is going to strengthen. I'm going to wait. I need to sell, so I'll wait. So a mixture of both is not ideal because this is where it falls below your objective for the year. And if the market doesn't move in your favor, and we all know that we cannot beat the market, if not, I wouldn't be here and you wouldn't be here. But this is one of the mistakes that I've seen in the past. One pitfall is the limited visibility from the company about their exposure. And this is mostly due to systems, to visibility. A lot of time when I talk to companies, they say, oh, I'm exposed to 2 million euros. And then when we dig deeper, it's 10 million euros. So the data was not available easily for them to be able to track what's the forecast and in which currency. Or the forecast is on a very short term versus a long term. The problem is when you don't have visibility as a company, you might end up being either overhedged. And when I say overhedged is having contracts locking the currency for more than what you need, or underhedge. If you decide to hedge 50% and you think your exposure is $2 million, you end up having 10, then you hedge 4 million less than whatever you need. The last one I'm going to talk about before I move to the next slide is the responsibility. And this is why the policy comes and it's very important. A lot of controllers, VP of finance, decision makers do not want to take the responsibility on top of all what they do on a daily basis. If they come in, the previous person did not hedge, they don't want to change the status quo. They want to keep everything the same. Or on the other side, they're worried that the owner or the manager is going to come and say, why did you hedge? Why did you take that decision? It shouldn't be that way. So a lot of time, not challenging the status quo, not to take an extra responsibility where you don't have any visible gain or any reward if you perform well, and you protect the business. It's like saying, I'm not going to buy a home insurance because I believe my house will not burn the next year. It's exactly the same mentality. I'm not going to hedge because I don't think the rate is going to move away from me. So this is on in terms of managing the currency risk. Now, just to go very quickly, I'm going to go through a use case. Company back in 2022, we worked with, their main objective was to reduce the volatility of cash flows. It's a manufacturing company based in Canada. They purchase $1 million US on a monthly basis. And again, back in 2022, they experienced up to $200,000 difference in cash flow payables, depending on where the market was. And this is because they didn't hedge. Long story short, we spoke with them. We start with the planning phase. We decided that they're going to do a layered hedge, 4 months at $1 million, months 5, 750, 500, and 250. And on a monthly basis, we're going to add $250,000 to keep their ladder the same and using specific type of products. Then we wrote it on a paper, so we created a policy. And that policy that we created, we labeled it 0.0 on top right. And every time they need to make changes of that policy, they needed 2 senior executives to sign. The execution, as I mentioned, initial hedge, so December 2022 initial hedge, 1 million for 4 months, then 750, 500, and every single month adding a layer of 250,000, keeping them at $1 million per month, using again limit orders to achieve that. And this is the most important part, is how did we do? If they haven't hedged during 2023, this is how their cash flow would have looked like. You can clearly see on the layering hedge how the cash flow was way smoother in terms of cost. They didn't have that fluctuations, knowing that when you go in the future, it's a lagging result. So if the rate goes down, you will see that in 6 months or in 5 months because you log the rate in advance. Every single time we spoke with them, we showed them their exposure, and their exposure should have been exactly like we decided, is $1 million for 4 months, then 750, 500, and 250. In terms of dollar value, their benchmark was a rate of 135 on the USD CAD. We achieved an average of 133.75 or 74, which means in dollar value, we saved them 139,000 versus the spot, or 151,000 versus the average period of like their budget rate. That's it from my end. I think we can open it to questions.
Karim, we've got a question from Gerard. He's asking, would there be a swaps on rolling contract?
It depends if there is a need to swap them, right? So a swap literally means I'm pushing or I'm pulling a contract to the future. I'm moving that contract to the future. So again, I'm going to talk about Convera. We can do the swap in 2 different ways. The first one can be done at market rate, which means we cancel the contract. You either receive the gains or you pay the losses, and we book a new forward contract at the market rate. Or what we can do is a historical rate, which means we keep the same rate and we push it to the future. So these are 2 ways, yes, we can do. Most of the time, the swap is because you haven't received the funds at that timing. It's very important to know that the best hedging execution is if you match your contract with your receivables or payables. The more you move these contracts, the more expensive it might be for you.
Wonderful. I see you just popped up a QR code there that you can get a free risk management seminar from you.
So yeah, so for the members of IFOL, we offer a 3 hours consultation to answer, because again, in half an hour, you will get just the basic. You will get whatever we can explain in half an hour. It's a way more complex study. So in case you need to ask more questions, deep details, if you want us to look at your exposure and give you kind of, I wouldn't call it an advice, but the strategy, you can always sign on the QR code for the 3 hours consultation fee.
Wonderful. Thank you for your time. For more information on you, where can they find you aside from LinkedIn?
So they can easy on LinkedIn. I can share my contacts with you. So these are my contacts by email. If they can reach out to me by email to karifra@convera.com. As you can see, very easy email. It's the first letters of my first name and the last 3 of my last name.
Wonderful. Thank you for Convera for sponsoring this session, and thank you for your time. Very informative. And like you said, you just scratched the surface. So I encourage our attendees to reach out to you. And thanks again. And we look forward to having you on our panel discussion again.
Thanks again, Rob. Thanks, everyone.